Unlock your tax benefits. The One Big Beautiful Bill explained. The One Big Beautiful Bill offers Americans a wealth of tax advantages. Experts advise taking advantage of new provisions enacted earlier this year, even before tax season officially opens. Here's what you need to know. No tax on tips and overtime. The bill eliminates federal tax on tips. https://www.usatoday.com/story/money/2025/077/02/Trump-bill-no-tax-on-tips-explain/84447598007 and overtime pay. https://www.usatoday.com/story/news/2025/077/13/no-tax-on-BBB-works/84638177007. Though the $6,000 senior bonus deduction remains a standout feature, https://www.usatoday.com/story/money/personal-finance/Susan-Tompor/2025/07/1/4/taxes-social-security-trump/84533929007. These changes align with broader efforts to reduce tax burdens, but there's more to explore. Charitable contributions and auto loan deductions. The bill reintroduces a charitable contributions deduction for standard deduction taxpayers, effective 2026. During the 2020 pandemic, individuals on the standard deduction could claim up to $300 in cash donations. https://www.usatoday.com/story/money/2021/2/6/reduce-my-taxable-income-2021/90201650002, which was expanded to $600 for married couples filing jointly. https://www.usatoday.com/story/opinion/2025/001/28/tax-cuts-jobs-act-hertz-donations-taxes-philanthropy/77-87-9937007. Under the new law, taxpayers can deduct $1,000 per person or $2,000 per couple through above-the-line deductions, bypassing itemization. https://www.usatoday.com/story/money/2025/06/03/car-loan-interest-tax-deduction-trump-qualify/83988804907. This is especially valuable for families seeking to lower their taxable income. Auto loan interest deduction expansion. For the first time, personal auto loan interest is deductible for non-itemizers, a change that could simplify tax planning. Previously, this deduction was only available as an itemized expense until 1986. https://www.usatoday.com/story/money/proposed-car-loan-deduction-detroit/75628009007. Under OBBB, taxpayers can deduct up to $10,000 in interest from 2025 to 2028, though eligibility requires purchasing a new, U.S.-assembled vehicle for personal use. https://www.usatoday.com/story/money/personal-finance/2025/06/03/car-loan-interest-tax-deduction-trump-qualify/8398880499007. Some experts caution that strict criteria may limit access, but the decision to buy or lease a car and its cost could shift dramatically. Family-focused benefits. Families taking the standard deduction should also consider these updates. 1. Dependent care flexible spending accounts. DCFSA. The bill raises the annual maximum contribution to $7,500, or $3,750 for married couples, from $5,000, effective next year. https://www.newfront.com/blog/how-the-beautiful-bill-effects This increase mirrors a 2021 boost under the American Rescue Plan Act. Though it's not tied to the pandemic, https://www.usa.today.com/story/money/personal-finance/susan-tom-poor/2022/12-09/tax-refund-return-stimulus/696962390072. 2. Child and Dependent Care Credit. CDCC. The credit rate jumps to 50%, up from 35%, for qualifying expenses, offering up to $3,000 for one child and $6,000 for two or more, starting in 2026. https://www.usa.today.com/story/money/2025/06/03/car-loan-interest-tax-deduction-trump-qualify/839-880-49007. The income threshold for the lowest 20% credit rises to $206,000 for married couples and $103,000 for individuals, reflecting broader economic shifts. These changes could benefit nearly 4 million families, according to the First 5 Years Fund. https://www.first5years.org. Under current law, a family with 2 young children earning less than $150,000 typically receives around $1,200, said Sarah Rittling, the organization's executive director. With enhancements, this amount could rise by $900, potentially making a significant difference for families managing tight budgets. Experts emphasize that while these provisions are beneficial, they require careful planning. For instance, boosting a 401k contribution could help qualify for a larger CDCC in 2026. https://www.usa.today.com/story/money/202594-89007. Additionally, new income phase-outs may complicate tax strategies, so vigilance is key. Medora Lee, a USA Today reporter specializing in money and personal finance, highlights the bill's potential to reshape tax planning for millions. For more insights, follow her on social media or subscribe to USA Today's free daily money newsletter. https://www.usa.today.com/story/news/investigations/2023/1-1/1/7/election-fraud-ads-facebook/71611159007. Trump's Big Beautiful Bill. Key tax changes for 2025 explained. Your wallet is about to feel the impact of a major shakeup. President Trump's One Big Beautiful Bill is now law, and its tax changes for 2025 are a game-changer. While the bill promises working family tax cuts, the reality is far more nuanced. Some will benefit handsomely, while others might face unexpected hurdles. And this is the part most people miss. The devil is in the details, and those details could significantly affect your bottom line. It's been 2 weeks since the bill's passage, and financial advisors are still deciphering its complexities. The changes, effective for 2025, will impact tax returns filed in 2026. But here's where it gets controversial. While some provisions seem universally beneficial, like increased standard deductions and a higher child tax credit. Others introduce complexities that could leave you scratching your head. For instance, the bill extends Trump's 2017 tax cuts, including lower tax brackets and higher standard deductions, which generally reduce taxes for Americans. However, it also introduces a temporary higher cap on the state and local tax, SALT, deduction, rising from $10,000 to $40,000 for 2025. Sounds great, right? Not so fast. This higher SALT benefit phases out for incomes between $500,000 and $600,000, creating what some experts call a SALT torpedo, an artificially higher tax rate of 45.5%. This means there's a sweet spot for the SALT deduction between $200,000 and $500,000 of earnings, according to CPA John McCarthy. But wait, there's more. The bill also introduces temporary tax breaks, such as a $6,000 bonus deduction for older Americans aged 65 and over, new deductions for tip income, overtime earnings, and car loan interest. These changes, while beneficial for some, add layers of complexity to tax planning. Without careful income planning, you could inadvertently reduce or eliminate tax benefits you're eligible for. And this is the part most people miss. The premium tax credit subsidy cliff is back. During the pandemic, Congress boosted this credit, making marketplace health insurance more affordable. However, Trump's bill didn't extend this enhancement, which could lead to higher Affordable Care Act premiums for over 22 million enrollees. Starting in 2026, enrollees need to prepare for the ACA subsidy cliff, where even a $1 increase in income above the threshold can result in losing the premium tax credit. So what does this all mean for you? It means that understanding these changes is crucial. Here's a thought-provoking question asterisk with the complexities and potential pitfalls of this bill. Do you think it truly delivers on its promise of working family tax cuts? Or does it favor certain groups over others? Let us know your thoughts in the comments below. The impact of this legislation will be felt for years to come, and your perspective could shed light on its real-world implications. Unveiling the tax cuts in Trump's big, beautiful bill. What you need to know. Get ready for a potential shakeup in your wallet come 2026, thanks to the One Big Beautiful Bill Act. But here's where it gets controversial. While millions of taxpayers are poised to see lower tax bills, the benefits aren't spread evenly. A recent analysis by the Tax Policy Center reveals that every income group will save some money, but higher-income Americans are set to reap a disproportionately larger share of the rewards. On average, households will save about $2,900 in 2026, but the devil is in the details. This law, signed by President Trump on July 4th, extends the tax cuts from his 2017 Tax Cuts and Jobs Act, which were originally set to expire. It also introduces a slew of new tax breaks, such as eliminating taxes on overtime and tips, and raising the state and local tax deduction cap from $10,000 to $40,000. Sounds generous, right? And this is the part most people miss. About 60% of the tax breaks will go to the top 20% of households, those earning $217,000 or more annually. For context, a household in the bottom income quintile, earning up to $34,600, will save around $150, or just 0.8% of their income, while those in the top quintile will pocket an average of $12,540, or 2.5% of their income. Of course, individual savings will vary based on factors like the number of children, thanks to the child tax credit, or eligibility for new breaks like the tipped income tax exemption. But the disparity has raised eyebrows. A July 18th poll from the Associated Press and ORC Center found that over 60% of adults believe the law favors the wealthy and could harm lower-income groups. Is this a fair distribution of tax relief, or does it widen the wealth gap? Adding fuel to the fire, the law also cuts spending on social safety net programs like Medicaid and food stamps. While proponents argue these measures will stimulate economic growth, critics worry about the long-term impact on vulnerable populations. What do you think? Does this bill strike the right balance? Or does it tilt too far in favor of the affluent? Asterisk, let's hear your thoughts in the comments.